Hi everyone, welcome back to my channel. Lovely to have you here. My name is Corinne Thompson. I am the CEO and founder of eCap Financial. We provide fractional CFO services for companies who are either fundraising or going through an M&A process. We also do financial due diligence for predominantly venture capital funds who are looking to invest in companies. Now, one thing that I want to touch on today, which I think is relevant if you are going through a due diligence process for investment, is something that investors will often ask me to do when I'm doing that financial due diligence, and that is sensitivity analysis. And I just want to kind of cover what that entails so you know what's going to happen when we take your financial model and we take your kind of expectations for the company, and then we put it through the sensitivity analysis. So the first thing that I will always do with a financial model is I will start by taking the revenue tab and look at the pipeline of deals that basically makes up that revenue tab. So I normally ask for an export from HubSpot, Pipedrive, Salesforce, whatever the company uses, if that's not already linked into the financial model. We then basically apply a probability weighting to each of those. So things like HubSpot normally have like a weighted percentage against them from like a pipeline perspective. If that's not in there, I often see pipelines without that in there, I will then apply like a percentage weighting to that pipeline number. This then gives me a view in terms of like what that haircutted revenue might look like going forward. If there are any one-off fees or implementation fees in here, I also tend to discount them as well because, particularly if this is a SaaS company and they have a SaaS element to the business and there's these like one-off implementation fees, that tends to account for a fair bit of the revenue, particularly in the early years of a company. So again, I will discount those. I will then do a haircutting exercise on that revenue number again. And the reason I do this is because one thing that I don't build into the pipeline analysis is that often deal dates will move and they invariably move one way, which is back. And so one thing that I'll do is I'll apply that kind of revenue sensitivity on the face of the P&L as well, just to stress test that revenue to see where we get to then from like a cash flow perspective. From a cost perspective, what I will do is I will look at the historical cost of the business. And what I often see happen is companies will have a cost of sales where that margin wildly improves over the next couple of years. And the reality is, like, while you can present that going forward, it's not necessarily going to be the way in which it kind of like pans out or converts. And so what I will normally do is I'll say, okay, if that cost of sales, or the gross profit margin, has gone from like 66% through to like 90%, I will say, okay, we'll give improvements in there. But like the benchmark for a SaaS-based company is between 70 and 75% in terms of that gross profit margin. So I will take that gross profit margin up to that certain percentage, and I will forecast that number forward. As I mentioned in other of my YouTube videos, like making sure you have the right costs and cost of sales are also critical as well. I often see people missing out things like customer support. Customer support is critical in most companies for maintaining that customer revenue going forward. Customer success, however, typically goes in operating expenses because they are the ones driving expansion revenues. They're the ones like almost like upselling and bringing that new revenue in, whereas customer support are the ones kind of maintaining the revenue that you have in place at the moment. And I see this often missed out. So make sure you include that. So that's another way we apply sensitivity on the gross profit margins. And then we look at the operating costs of the business. And we basically say, okay, what is being forecasted in terms of like headcount versus like what do we have in the business at the moment? And I'll spend quite a bit of time, I make this process sound like I just sit here with a spreadsheet. And in fairness, I do to start with. But I will also spend quite a bit of time with the company understanding what the cost to acquire a customer is, like what the headcount requirements are in order to like scale up and ramp up that sales team. Is there enough kind of appropriate sort of like support within those teams? So for instance, like sales teams, you can have SDRs, you can have account managers, but then you also need things like revenue operations, for instance, to support the running of the business and the data aggregation and compilation for the business. So again, I'll understand like what the headcount has been before and what the headcount is going forward. I typically will tweak up these numbers slightly because in my experience, like companies will often underestimate or just not know what costs they need in the business to carry that business forward and actually like go through that scale process. And there's often roles that appear, in later company stages that nobody really thinks about in the earlier company stages. For instance, head of legal or like corporate development or like head of partnerships. Like these are roles where, when you're starting out or you're in the first couple of years, they're not necessarily roles that you necessarily think about at that point in time. Other kind of core areas that I tend to tweak with, and again, it depends on like the metrics that we compile. So again, making sure that we have a consistent cost to acquire a customer, similarly with like the lifetime values of a customer as well. And we can show improvements over time, but not having these like radical changes in terms of like then what the metrics are looking like. Like annual contract values, for instance, or like ARR per FTE can definitely strengthen over time, but it's not going to like wildly change within the space of like 1 year. Other metrics we look at in a lot of detail are things like rule of 40, for instance, or like magic number. So again, using these and using the costs and understanding, okay, which ones maybe need a little bit of like a tweak up just in terms of just adding a little bit more buffer in there. The overall kind of process for doing this, or the reason why we're doing this, is we're trying to understand the impact on the cash flow. And one of the things I find that companies kind of underestimate is actually the importance of like how quickly you can get paid by your customers. So we call it kind of like receivable days when it comes to finance language. And making sure that those receivable days are as compressed as possible, i.e., you send an invoice out and you get paid pretty quickly from that invoice. And sometimes I see, financial models or forecasts that have like a 30-day payment period from like sending an invoice to receiving the cash, which, if you're working with large enterprise customers, sometimes is just not realistic or not the reality of then what is going to happen in terms of like seeing that money coming into the bank account. So through moving these different levers, we can get a set of different scenarios of like, okay, if we tweak the revenue down and we increase the costs and we move the kind of receivable days and we move the payable days, like what does that mean in terms of like that cash flow and that runway? And ideally investors are looking for like, how long will my investment last in this business from like a runway perspective? Like how many months have we got here in terms of runway? So that's one thing just to bear in mind. And I'm saying that if you're going through a due diligence process and you are, you're building your financial model, just be mindful that it is then going to be stress tested as part of this kind of like DD process for taking on investment. Anyway, I hope that's been useful, and thanks very much for tuning in. If you like this video, please subscribe to my channel, and if you want to send this video to make it go viral, that would be wonderful too. Thanks very much. Bye-bye.